Hello again. This video is for Senator Dodd, Chairman of the Senate Committee on Banking, Housing, and Urban Affairs, and any other member of Congress or HUD with an interest in fixing our economy now. We all know this national and global economic crisis began with subprime mortgages. It's obviously spilled over into the entire housing, auto, and retail industries. It has affected all Americans, from the simplest of consumers to the biggest of industries. Most importantly, money is not circulating. Businesses of all types are downsizing or shutting down, which means jobs are being lost and unemployment is skyrocketing, all because subprime mortgages were poorly designed. The news is filled with lots of alarming economic numbers and indicators, as well as a variety of human interest stories, but while the seed problem, which is the solution, is sometimes addressed, it is too often overlooked and ignored. Now, having said that, I'm going to grant you the most complete and comprehensive solution for everyone, without any form of bailout. So, let's get to the solution: getting mortgages paid. Here, in fact, is our solution. Number one, Congress must mandate an immediate moratorium on foreclosure. This is a simple timeout while we resolve the crisis. Obama actually campaigned on this. 90 days is enough time. Number two, Congress must mandate an immediate forbearance. Again, a simple timeout to suspend late payments and fees. Number three, Congress must mandate all subprime loans to a maximum margin of 2.5%. Lenders are to accept 3 temporary payments with maximum margins of 2.5%. Now this is the seed. Okay, here we are at number 3, capping margins at 2.5%. This is what I'm talking about when I say the seed of a global economic crisis. It was born right here. You'll understand what I mean in just a few seconds. Okay, now I'm in California. I'm going to use California pricing. Nationwide numbers will vary, but they're all relative. Okay, so let's take a couple that bought a property 2, 3, 4 years ago for $400,000. They bought it with 100% financing. The lender broke it up into 80-20 to avoid mortgage insurance. Okay, that new loan amount is $320. At 6%, their payment is $19.19. That second is $80,000. There's no mortgage insurance, but it's got a higher interest rate, and that payment is $762. We combine these two, we get $2681. That is their payment for 2 years. Now, 2 years later, this interest rate becomes a margin. Okay, here it is, 6%. Now that gets tied to and added to an index of 3.5%. We use 3.5% in this case. That gives us a new interest rate of 9.5. So now, with a balance of 311 and a new interest rate of 9.5, this is their payment, $2657. We add that second payment, $762. We have a combined payment of $3419. Now their payment went up overnight from 1 month to the other, over $700. Now, I use 6%. This is gouging the outrageous. I use 6% because this could have been anywhere between 5.5% and 8.5%. Now, it's outrageous because when you consider the fact that A-paper loans or prime loans have margins of between 2 and 2.5%, we could have had a softer landing. That is why I say that this is the seed, this is the gouging the outrageous, the seed that caused our global economic crisis. So now, let's recap. Steps number 1 and number 2 are timeouts. Step number 3 is a temporary payment with capped margins. Okay, the permanent solution is number 4. Congress must streamline the FHA Secure for Homeowners program. All homeowners that are upside down, underwater, or have an adjustable rate mortgage automatically qualify to refinance, provided they 1. Occupy the property as a residence, and 2. Made the initial 24 fixed interest rate payments on time. Now, we all know that property values have dropped, and typically the holidays are the worst time to sell property because, for 1, the days are shorter, 2, the kids are in the middle of the school year, and 3, people are not typically in the mood to purchase a home. They'd rather be home for the holidays. So now, what we want to do is we want to do an appraisal on the property, and let's just say that the value right now is $300,000. Remember, they bought it for $400,000. So now the new loan amount would be 97% of that $300,000, which in this case would be $291. At 6%, their payment is $1745. Okay, there's going to be what is called upfront mortgage insurance, and that is 3% of the loan amount, which in this case is $8730. That goes straight to the FHA insurance fund to be used at a later date for future defaults. Now, We have a maximum 1% origination fee that goes to the bank or the broker. Maximum processing fee, estimated closing cost. We have net proceeds of $275,955 in this case. Now the key is that they get it now. Okay, so now remember the payment was $1,745. We brought that down here. Besides this upfront mortgage insurance premium, the homeowner is going to have 1.5% annual premium, which is paid monthly. In this case, that'll be $363, giving them a combined payment of $2,108. Now remember, originally it was $2,600. It went up to $3,400, and now it's back down to $2,100. Logically, if they made $2,600 payments on time, they should be able to make $2,100 payments on time. Now the challenge here is to get banks to realize the inevitable. Okay, this also benefits them. And on this next segment, I'm going to show you how and why. Here we are with what I call the do-nothing alternative for banks. Okay, this is the standard procedure, the status quo foreclosure. Okay, now remember, the bank invested $400,000 into the property. They took it back in foreclosure, and they're selling it for $300,000. Now, this is being generous because values are still dropping. Okay, they pay property taxes, commissions, closing costs, repairs, buyers' closing costs. Their net proceeds are $260,000 in 2 years. Now, it took a year to repossess the property. It took an additional year to market and sell it if they're lucky. Now, compare that to what I'm proposing right now, $276,000 now. Okay, this may not be a big difference, but when you factor in the 2 years and additional losses, 1 year's interest while they repossess the property, an additional year's interest while they market and sell the property, again, if they're lucky, and all these additional costs, they've got a loss of $80,000 to $120,000. Additional losses not included here. So now, besides this stop loss program that I'm proposing, I've got one sweet deal of an instrument for investors, and that's coming up now. Okay, here is the clinching home run. The homeowner will execute an instrument in refi escrow. Lenders will receive an equity share silent second. This new fully negotiable instrument is a second lien which is due upon sale, is worth 50% of the seller's net proceeds at sale. If there is a second, the split is 40% and 10% respectively between the two existing lenders. The yield is 0% interest during the life of the lien. The entire return is the equity realized at sale. The return is the growth based on the present zero equity up to the deficiency amount which is disclosed at origination. It may be negotiated at any rate of discount mutually agreed to by both homeowner and lender at any time during the life of the lien. In the event of future appreciation, homeowner may refinance to pay off the equity share silent second using the streamline. Now, I'm going to opinionate one quickie here. I recommend in anticipation that future instruments reborn in the form of 100% plus mortgages in the model of FHA's Title I be limited to the sole purpose of paying off this equity share silent second at the lenders and homeowners negotiated and agreed upon amount. Number 5, Oreo suggestion. Okay, now I really like this idea, but because I'm running out of time, you're going to want to copy this by pausing. Now remember, these are homeowners who made their payments on time while the interest rate was fixed the first 2 years. Senator Dodd, please review and consider the contents of this video. I've been working on it since March, and it's very difficult to cover it all in a 10-minute video. If you have any questions and require clarification, you have my contact information on YouTube. I would love to explain it to you in greater detail. If anyone who is watching this video knows a senator or how to contact him, please forward it to him. Thank you.